Ladies and gentlemen, what if the biggest opportunity of this decade isn't AI, real estate, or Bitcoin, but a metal most people have ignored? Right now, silver is trading around $58, yet Citi is reportedly telling clients it could reach $150. At the same time, JP Morgan CEO Jamie Dimon continues to warn about economic uncertainty and growing debt. Is this just another bold prediction, or are we witnessing the early stages of a historic bull market? Today, we'll separate hype from reality and uncover what the smart money may already be seeing. For years, silver was treated like the forgotten precious metal. Gold captured the headlines, central banks accumulated reserves, and most investors viewed silver as an afterthought. That perception has changed dramatically. Today, silver is attracting renewed attention, not because of a passing trend, but because several powerful forces are converging at the same time. When multiple long-term drivers begin moving in the same direction, markets tend to notice, and that's exactly what's happening. One of the biggest misconceptions about silver is that it's only valuable because it's a precious metal. In reality, silver occupies a unique position unlike almost any other commodity. It serves two worlds simultaneously. On one side, it's recognized as a store of value that has preserved purchasing power for thousands of years. On the other, it's an essential industrial material used in modern technology. That combination makes silver fundamentally different from most assets. When both investment demand and industrial demand increase together, the supply-demand equation becomes much tighter. Industrial consumption has become one of the strongest stories supporting silver. The modern economy depends on electronics, renewable energy, telecommunications, medical equipment, and advanced manufacturing. Silver's exceptional electrical and thermal conductivity make it extremely difficult to replace in many applications. Engineers don't choose silver because it's fashionable. They choose it because it performs better than alternatives. Even if manufacturers try to reduce the amount of silver used in each product, the sheer growth in production often outweighs those savings. The global push toward electrification has only accelerated this trend. Solar panels require silver to efficiently conduct electricity. Electric vehicles contain significantly more silver than traditional vehicles, and expanding electrical infrastructure increases demand across multiple industries. This isn't a temporary cycle driven by speculation. These are structural changes taking place over years, even decades. As countries invest in cleaner energy systems and modernize infrastructure, silver quietly becomes an increasingly important component behind the scenes. At the same time, the supply side tells a very different story. Many people assume that if prices rise, mining companies can simply produce more silver. It's not that simple. Developing a new mine can take years of exploration, permitting, financing, environmental approval, and construction before production even begins. Mining isn't like turning on a faucet. Even when higher prices encourage investment, additional supply often arrives much later than the market expects. Another factor often overlooked is that much of the world's silver isn't mined primarily for silver itself. A large percentage comes as a byproduct of mining for copper, lead, zinc, or gold. That means silver production depends heavily on the economics of entirely different metals. Even if silver prices climb sharply, production won't necessarily increase unless those primary mining operations also expand. This creates a natural limitation on how quickly supply can respond to rising demand. Inventories also deserve attention. Every year, silver is consumed in countless industrial applications. Unlike gold, which is often stored in vaults and preserved, a significant portion of silver ends up dispersed in products where recovering it isn't always economical. Some silver is recycled, but much of it is effectively removed from readily available investment supply. Over time, this gradual consumption creates pressure that many casual observers underestimate. Investor psychology is another important piece of the puzzle. Markets move not only because of fundamentals, but also because perceptions change. Silver has spent long periods underperforming other popular investments, causing many investors to ignore it. Yet markets often reward patience. Once sentiment shifts and more people begin recognizing improving fundamentals, capital can flow into a relatively small market surprisingly quickly. Because the silver market is much smaller than many financial markets, even modest increases in investment demand can have an outsized impact on prices. Economic uncertainty also contributes to silver's renewed appeal. Investors naturally look for assets that can provide diversification when confidence in financial markets weakens. Inflation concerns, government debt, currency fluctuations, geopolitical tensions, and broader economic uncertainty all encourage people to reconsider tangible assets. Silver has historically benefited during periods when investors seek alternatives outside traditional financial instruments. While no asset performs perfectly under every condition, Silver often attracts attention when confidence in paper assets becomes less certain. It's also worth remembering that silver is historically a volatile market. Price swings can be dramatic in both directions. That volatility discourages some investors, but it also reflects the relatively small size of the market compared to stocks or bonds. Rapid changes in buying or selling activity can produce large price movements over relatively short periods. Understanding this characteristic is essential because volatility is part of silver's nature, not an exception. Another reason silver is returning to the spotlight is growing public awareness. Information spreads faster than ever, allowing more investors to study supply trends, industrial demand, mining challenges, and historical market cycles. As education improves, more people begin viewing silver through a broader lens rather than simply watching daily price fluctuations. Long-term investors focus less on headlines and more on whether the underlying fundamentals continue strengthening. Ultimately, silver's renewed attention isn't built on a single prediction or one dramatic news story. It's the result of multiple forces reinforcing each other. Expanding industrial demand, constrained mine supply, increasing recognition as a monetary asset, ongoing global electrification, limited inventories, and renewed investor interest during an uncertain economic environment. When several independent factors point in the same direction, it's worth paying attention. The important lesson is not to become obsessed with specific price targets. Markets rarely move in straight lines, and short-term corrections are inevitable. Instead, the real story lies in understanding why silver is becoming increasingly important in today's world. Its unique role as both an industrial necessity and a tangible store of value places it in a position few other assets occupy. Whether prices move quickly or gradually, the underlying fundamentals suggest that silver is no longer the overlooked metal it once was. It's moving back into the spotlight because the world increasingly needs what silver provides. And that reality may prove far more significant than any headline or forecast. When respected voices in global finance begin warning about rising debt, persistent inflationary pressures, fragile markets, and growing geopolitical uncertainty, experienced investors pay attention. The important point isn't to react emotionally to every headline or speech. It's to step back and ask a much more important question. What do these warnings tell us about the environment we're entering, and how does silver typically behave under those conditions? Financial markets thrive on confidence. Confidence in governments, confidence in currencies, confidence in banking systems, confidence that debt can continue expanding without consequences. But history teaches us that confidence moves in cycles. There are periods when optimism dominates, and there are periods when investors begin questioning whether the risks have become larger than the rewards. Today, one of the biggest concerns facing the global economy is the sheer amount of debt. Governments around the world have accumulated obligations at levels that would have seemed unimaginable decades ago. Servicing that debt becomes increasingly difficult as interest rates rise. Higher borrowing costs mean governments must spend more money simply paying interest, leaving fewer resources for everything else. It's a challenge that doesn't disappear overnight. Debt itself isn't necessarily the problem. Productive debt can help build infrastructure, expand businesses, and stimulate economic growth. The concern arises when debt grows much faster than the economy supporting it. At some point, policymakers face difficult choices. They can reduce spending, increase taxes, borrow even more, or allow inflation to reduce the real value of debt over time. None of these choices is painless. This is where precious metals begin entering the conversation. Silver has never depended on promises from governments or financial institutions. It doesn't require confidence in a banking system to maintain its physical existence. For thousands of years, people have turned toward tangible assets whenever uncertainty about paper assets increased. That pattern has repeated throughout history. Regardless of which country or currency was involved, inflation is another critical piece of the puzzle. Many people think inflation is simply higher prices at the grocery store or gas station. Those are only symptoms. Inflation represents a gradual decline in the purchasing power of money. When more currency is created than the economy's productive capacity can absorb, each individual unit tends to buy less over time. For savers, this creates a silent challenge. Money sitting in cash may appear safe because the number on the account statement doesn't change dramatically. But if purchasing power steadily declines, that apparent stability can become an illusion. Tangible assets have historically served as one method of preserving wealth during periods when currencies weaken. Silver occupies a particularly interesting position because it benefits from more than one economic trend. Unlike assets that rely entirely on investment demand, silver also enjoys substantial industrial demand. Even during uncertain economic periods, society continues expanding electrical infrastructure, manufacturing advanced electronics, developing renewable energy technologies, and producing medical equipment. These industries continue requiring silver regardless of investor sentiment. Another issue receiving increasing attention is market concentration and financial leverage. Modern financial systems are built upon enormous amounts of credit, derivatives, and interconnected obligations. Most of the time, these systems function efficiently. But during periods of stress, leverage can amplify problems much faster than many participants expect. Events that initially appear isolated can spread rapidly across markets because institutions are increasingly connected. Physical silver exists outside that network. It carries no counterparty risk. Its value doesn't depend on someone else's promise to pay. That's one reason experienced investors often view physical precious metals differently than financial assets. It's not about expecting catastrophe. It's about recognizing that diversification includes owning assets that respond differently under changing economic conditions. Geopolitical uncertainty also deserves consideration. Global trade routes, international conflicts, sanctions, and political instability can disrupt supply chains almost overnight. Markets dislike uncertainty because uncertainty makes planning difficult. Businesses postpone investment decisions. Consumers become cautious. Investors seek assets perceived as relatively resilient during periods of instability. Silver's role becomes increasingly important because it combines industrial necessity with monetary history. Even if one source of demand temporarily weakens, another can provide support. Few commodities possess that dual character. Most industrial metals depend primarily on economic expansion, while most monetary assets lack broad industrial consumption. Silver bridges both worlds. One of the greatest mistakes investors make is focusing exclusively on daily price movements. Markets fluctuate constantly. News headlines create excitement one day and fear the next. Successful long-term investing requires looking beyond short-term volatility toward larger structural trends. Debt accumulation, demographic shifts, industrial transformation, energy transitions, and monetary policy all unfold over years, not weeks. That perspective changes how you evaluate silver. Instead of asking whether prices will rise next month, the more meaningful question becomes whether the long-term fundamentals are strengthening. If industrial demand continues growing, mine supply remains constrained, and investors increasingly seek tangible assets during uncertain economic periods, those forces gradually reinforce one another. It's also important to remain realistic. Silver is not a magic investment. It experiences corrections, periods of disappointment, and extended consolidations. Volatility is part of its character. Investors who expect a straight line upward often become frustrated. Those who understand the market's cyclical nature are usually better prepared emotionally and financially. The objective isn't to predict every price movement perfectly. No one consistently accomplishes that. Instead, it's about understanding why silver behaves the way it does during different economic environments. When uncertainty increases, when debt levels become a greater concern, when inflation erodes purchasing power, and when confidence in traditional financial assets weakens, silver often attracts renewed interest because of its unique combination of monetary history and industrial importance. Ultimately, the message isn't that every warning automatically guarantees higher silver prices. Markets are influenced by countless variables, and no single factor determines the future. However, when respected financial leaders consistently highlight risks involving debt, inflation, economic resilience, and global uncertainty, those warnings encourage investors to examine assets that have historically provided diversification during challenging periods. Silver's renewed relevance isn't based on fear alone. It's based on fundamentals. It exists at the intersection of technological progress, industrial necessity, monetary history, and financial uncertainty. Those characteristics make it one of the few assets capable of responding positively to multiple long-term trends at the same time. That's why serious investors continue watching it carefully, not because of sensational headlines, but because the underlying economic landscape increasingly supports its importance. The question everyone eventually asks is simple. Can silver really reach $150? It's an exciting number, and whenever bold price targets begin circulating, they naturally capture attention. But experienced investors know that focusing on a specific price target is often less important than understanding the conditions that could make such a move possible. Markets don't rise because someone predicts they will. They rise when supply and demand become increasingly out of balance. Price targets should never be viewed as promises. They're scenarios based on assumptions. If those assumptions prove correct, prices may move significantly higher. If conditions change, those projections may never materialize. That's why successful investing begins with understanding the fundamentals rather than becoming emotionally attached to any particular number. The first question to ask is whether the world needs more silver today than it did 10 or 20 years ago. The answer appears to be yes. Silver is no longer simply a precious metal stored in vaults or collected in coins. It has become an essential component of modern technology. Solar energy systems, electric vehicles, advanced electronics, telecommunications, medical equipment, defense applications, and countless industrial processes rely on silver because of its unmatched electrical and thermal conductivity. Demand driven by industrial growth is fundamentally different from speculative demand. Speculation can disappear quickly when sentiment changes. Industrial demand tends to develop gradually as manufacturing capacity expands and technology adoption increases. Every new factory, every expanding power grid, every new generation of electronic devices contributes to long-term consumption. These are structural trends, not temporary headlines. At the same time, demand has continued growing. Supply has struggled to keep pace. Mining is a slow business. Discovering an economically viable deposit is only the beginning. Companies must conduct exploration, complete environmental studies, secure permits, arrange financing, build infrastructure, and eventually construct processing facilities. The entire process often takes many years before the first ounce reaches the market. This delay creates an important reality. Even if silver prices rise substantially, additional production cannot appear overnight. Supply responds slowly, while demand can increase much more rapidly. Whenever that imbalance develops, prices naturally become more volatile. Another overlooked factor is that most silver production comes as a byproduct of mining other metals, such as copper, lead, zinc, and gold. This means silver output depends largely on decisions made for entirely different commodities. Even exceptionally strong silver prices don't automatically result in dramatically higher silver production because many mining companies are responding primarily to the economics of their main products. Investment demand adds another layer to the equation. The silver market remains relatively small compared to global stock markets, bond markets, or even gold. Because of that smaller size, shifts in investor behavior can have an outsized impact. If institutional investors, pension funds, family offices, or retail investors collectively decide to allocate even a small percentage of their portfolios towards silver, the available supply can tighten quickly. History demonstrates that silver often moves much faster than gold during strong precious metals bull markets. This isn't because silver is inherently superior. It's because its smaller market size allows capital flows to create larger percentage price movements. The same characteristic also explains why silver experiences sharper corrections. Volatility works in both directions. Monetary policy also plays an important role. Periods of low real interest rates, expanding money supply, persistent inflation concerns, and declining confidence in paper currencies have historically created favorable environments for precious metals. Investors begin looking for tangible assets that cannot be created electronically or expanded through monetary policy decisions. Silver often benefits from those changing preferences. However, it's equally important to recognize what could prevent silver from reaching ambitious price targets. A significant global recession could temporarily reduce industrial demand. Higher real interest rates may encourage investors to favor income-producing assets instead of precious metals. A stronger currency environment could also reduce